So this was the bear market in 1932, 1942, 1949, 1957. These are all the bear markets. This was the first year of the bull market. That's the second year. So you can see that out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 15. Out of 15 past bear markets, at the start of the second year of the bull market, how many were positive? How many were positive? Sorry, they don't include this. It's 14. Sorry, 14. Yeah. Because this we don't know yet, right? Altogether, 13 out of 14 second year bull markets were positive. Okay? So that is a 93% probability. So that's your answer. What's the chance the market will be up this year? 93% chance. And the average gain of a second year bull market is 11%. So we will probably get on average an 11% gain this year. Now, the other thing to remember is that we are not only in the second, but we are also within a larger secular bull market. Now, you have to understand the difference between secular and cyclical. Okay? What does secular mean? Secular means long term. Long term. Long term. That means 15 to 20 years. Alright? What is cyclical? Cyclical means shorter term, which is about 2 to 5 years. Okay? So we have got secular bull market and secular bear market. Understand? And within, let me just rub this away. And within a secular bull market, which we are in right now, within a secular bull market, you have got cyclical bull markets, and you have got cyclical bear markets. So let me explain where we are right now. So take a look at this chart over here. This is the very long-term chart of the US market going back 100 years, okay? And you can see that over the 100 years, the market is broken up into secular bear markets and secular bull markets. So over here, let me zoom in for you. Let me just zoom it in, okay? So can you see over here, this was a secular bear market that lasted 13 years. Secular. Inside this secular bear, you have got a cyclical bear market and a cyclical bull market. Can you see? Bear market, bull market. But within this big bear market here. Okay? Now, the secular bear market lasted 13 years. Question, does it mean during this secular bear market you can't make money? Can you still make money in this secular bear market? Yes or no? Yes, you can make a lot of money, right? Now, a lot of people will say, but Adam, right, in these 13 years, you didn't make any money. Because if you bought here, right, if you bought here, after 13 years, you are the same place, right? Let me ask you, which idiot, which cuckoo moron idiot would put all their money on this day? Only an idiot, right? So remember, as an investor, you want to invest consistently. You put money in every year. We call it dollar cost averaging, right? So you buy a bit, you buy a bit, you buy a bit, you buy a bit. Now, if you buy consistently, then where's your average price? Your average price is not the top here. No, your average price would be somewhere at the center here. You understand? Because of dollar cost averaging. So if your average cost is here, right, would you be making money over here? Yes or no? Yes. Now that's if you do dollar cost averaging blindly. But when good companies are undervalued, then your average price will be somewhere here. Right? Will be somewhere, which means even in a secular bear market, you're still making profits here. And when you learn how to use options, you can make a lot of money using options even if the market goes sideways for 10 years. By doing what we call cash secured puts, credit spreads, diagonal spreads, calendar spreads, and selling covered calls. So once you learn options, even if the market goes nowhere in 20 years, we can still make 20-30% a year by using what we call market neutral option strategies, which we teach in the options course. So are we afraid of secular bear markets? No. We can still make 20% returns in secular bear markets. But if we are in a secular bull market, right? So after a secular bear market, we go into a secular bull market here. This part over here. Now, is this much easier to make money than a secular bear? Yes or no? Yes, an idiot can make money in a secular bull market. Okay, so let's look at a pattern over here. Okay, secular bear, secular bull, secular bear, secular bull, secular bear. We are now in a secular bull market. Can you see that? We are right now here. Now, how long does a secular bull market last? This secular bull market lasted 20 years. This secular bull market lasted 16 years. Okay? Now, currently, this secular bull market started in 2013. Right? It started in 2013. So right now we are 2024, which means we are now in the 11th year, right? We are at the start of the 11th year of the secular bull market, right? Which means how many more years have we got left? Right? So if the secular bull lasts 20 years, and we're now in the 11th year, we still have what? We still got 9 more years of this secular bull. Okay? Now if you think it's only going to last 16 years like this one, then we have got 5 more years. So the point is, we have got between 5 to 9 more years of this secular bull, where money is a lot easier to be made before we go into another secular bear for 13 years. Follow what I'm saying? Now, what's also interesting is that, notice, in every secular bull market, there are 2 cyclical bear markets. Let me show you what I'm talking about. Let's take a look at this. So can you see in this secular bull market, we had a bear market here, bear market 1, bear market 2. Can you see? 2 cyclical bears in a secular bull. Now over here, same thing. In this secular bull market, bear market 1, bear market 2. So every time there's 2 bear markets. Now, good news. In this secular bull market we're in, we had our first bear market in 2020 and a second bear market in 2022. So we already finished our 2 bear markets. So based on quota, we are done with the bear markets. We should have no more bear markets until the end of this secular bull. Now again, there's no guarantee. I can't predict the future. This is just based on historical statistics and patterns. Okay? Now, not only is this the second year of the bull market, this happens to be a US election year. It doesn't matter who wins the election, Republican or Democrat, it doesn't really matter as far as the market is concerned. But here's an interesting pattern you see. If you look at all the election years, and you take an average of all the past election years, you will get this gray line, okay? So you can expect that the stock market, based on history, will end up higher this year. But statistically, based on seasonal patterns, we normally have a correction in the September to October period. Okay. We also tend to have a correction in the Feb to March period here. Right. So two corrections here, two major corrections, and we end up higher. Again, I'm not saying it's 100% is going to happen, but this is based on past patterns, right? Last year, the market gained more than 10%. So whenever we have an election year, after a 10% gain the previous year, we get this dark blue line. We get a dark blue line, which is similar, except the correction is not as much in September, October, but we've got a bigger correction in February, March. All right. So I am expecting that February and March to have at least a 5 to 10% drop in the markets, which I think would be a very healthy correction. After a very strong wave up, we should have a strong wave down. Sorry, a healthy wave down here in February, March, before we go up and then like that. All right. Again, this is just a rough guide. Okay. Are you still with me, everyone? All right, great. Now again, let's look at the underlying fundamentals that's driving the market. Let me say, Adam, you can't just say the market will go up based on patterns, right? There must be a reason the market will go up. You know, why is it going up? Why is it not going down? Okay. So let's look at all the reasons why the market is going up. Now, first of all, look at the chart, okay? And currently, if you look at the S&P 500, let me just bring up the charts for you right here, okay? This is the S&P 500. Currently, are we on an uptrend or are we on a downtrend based on the charts? Yeah, we are on an uptrend. Why are we on an uptrend? How do you know we are on an uptrend? Because what's the definition of an uptrend? An uptrend is defined as higher highs and higher lows, right? So we have got higher highs and we have got higher lows. That's an uptrend, right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up. Okay? And you can also look at the moving averages. Okay? So when you've got the 50 moving average, this blue line above the 150 moving average, it means it's on a medium-term uptrend. When the market is above the 200-day moving average and the 200 is sloping up, we're in a longer-term uptrend. So everything shows you that we are on an uptrend. And the trend is your friend. As long as the market remains on an uptrend, the path of least resistance is going up. It's like a river current. When the river current is flowing north and you jump into the river, you'll be carried north until the trend changes. When will the trend change? No one knows, no one can predict. But when the trend changes, then the trend changes. But for now, as long as the uptrend is in force, prices will continue to climb higher. Okay? So follow me on social media, on a private Discord channel, and of course I'll keep you updated to what's happening to the market trend. But right now the market trend is up. Now, although it's an uptrend, but would I jump into the market right now, right here? Would I jump into the market right now, right here? Yes or no? No, I won't. Why? Because wave up, wave down, wave up, wave down, wave up, wave down, wave up. I don't like to buy after it is waving up, because then I'm buying high, right? As an investor, I want to buy low. So I always want to wait for what? Wait for a wave what? Wait for a wave what? A wave down. That's right, wait for a wave down so I can add at better prices as an investor. High quality companies at lower prices. I don't want to chase the girl once the girl has run away. Remember that. Don't, never chase the girl. You chase the girl will turn around and give you one tight slap on the face. Okay? Be patient. Wait for the girl to run to you in your loving arms. And eventually she'll run to you once she gets scared by something. And she will get scared by something eventually. Okay? If you look at a longer time frame, let's look at weekly candles over here. And again, look at these weekly candles. You can see, right? Oops, hold on, give me a second, right? Yeah. So weekly candles, you can see here, right? Wave up, wave down, wave up, right? So eventually is going to, like I said, February or March, right? Coming up soon, it's going to drop. Now, of course, how much is it going to drop? We can just guess, right? So my guess is it will drop 5 to 10%. So my target would be somewhere about between here to about here. So these are 3 support levels I'm watching. So this first support is a previous swing high. It's a swing high here, right? And this was a 20 EMA. So this is the first support level. If it drops to here, it'll be roughly a 5% drop, okay? But if it's a deeper correction, then it drops to here, this would be about 10% drop. And then here, about maybe 15% drop. So anywhere between these levels. Now, can we predict the exact bottom of the market? Can we always predict the exact bottom? No one can predict the exact bottom. And here's the problem, right? Confucius said, men who try to pick bottom only end up with smelly fingers. So in other words, if you keep saying, I want to buy the bottom, I want to buy the bottom, you will never buy. You will never buy. Because you will always think the bottom is the next day. How many of you have experienced this before? When you wanted to buy a good stock, you say, I'm going to buy the bottom, but the bottom never came. And it ends up flying off without you because you thought the next day would be the bottom, right? And that's why as an investor, when I buy, I don't pretend to be able to guess the bottom because I don't know where's the bottom. So all I do is I buy when there's a potential bottom. When it's a potential bottom. What do I mean by potential bottom? So, example, these are 3 support levels, which could be the bottom, right? 1, 2, 3. So the moment the price drops to the first level here, okay, and if I see signs of a reversal, like I see a bullish candlestick pattern, and the certain indicators like the stochastics are oversold, okay, or the Bollinger Bands are oversold, and I see a bullish pattern here, then I will start to add shares here. But will I buy everything at one go? If I wanted to buy 100 shares, would I buy all 100 shares right here? No. I would buy maybe 1/3 first. I'll buy maybe 30 shares first, or 33 shares, right? Why? In case it breaks the support and finds this bottom. Then I've got cash left to add more, right? And again, I'll wait for a kind of a reversal pattern here. And usually, if it drops all the way to my last level, then by then I'll deploy all my cash. And by then, it would be somewhere near the bottom. Then you will go, hallelujah, you go up there, right? Of course, it could go down a bit more, you never know. You can never pick the absolute bottom. Remember this, you don't have to buy the absolute bottom to make money. You just have to buy near the bottom, right? So whether it's here or here or here, you will do very well, okay? But if you keep waiting to buy at the bottom, chances are you'll never, ever get in, you know? So all this is based on psychology, if you will, right? Investing and trading psychology. Okay, so having said that, let me now quickly run through the bullish thesis. Okay, there are 8 reasons to be bullish. Number 1, the Federal Reserve is now in a different mode. Okay, now remember that in 2023, what was the Federal Reserve's main mission? Their main mission was to bring inflation down. And they were willing to crush the economy. They were willing to sacrifice the economy in order to bring inflation down. So the stock market had to fight the Fed. The economy had to fight against the Fed to do well, right? But now we have seen that inflation has come down. In fact, the latest inflation reading we got 2 days ago showed that inflation is now dropping more than expected. So now the Fed has pivoted. And now their main focus is no longer killing inflation. Their main focus is to support the economy. So now the Fed is the friend of the economy. So that is something that is bullish. Okay? Number 2, as I showed you, last year, besides the Magnificent Seven, most other companies, their earnings was in a recession. Earnings growth was negative. But as of this year, recovering. So this earnings growth should support stock prices, especially stocks that are outside the Magnificent Seven. Okay. Number 3, the Purchasing Managers Index is bottoming and just started into expansion territory. The Purchasing Managers Index, or PMI index, measures economic activity, right? There's the manufacturing PMI and the non-manufacturing services PMI. It has been going down for the last 1 year. It has bottomed and is beginning to expand again. So that will be very good for industrial stocks, especially. Industrial stocks like Caterpillar and what's the other one? Honeywell and Deere and stuff like that. And that's why those stocks have begun rebounding pretty strongly. Okay. Next, the falling 10-year Treasury yield, which is the government bond yield. It went up to 5%. Since then, it has been coming down, although rebounded a bit in the last few days, but still way below 5%. So that means long-term interest rates have come down quite a bit. That is causing mortgage rates to come down. So that should spur more demand for housing in the US. Plus, it's causing financing costs to drop, which is good for companies. So companies now can borrow with less interest, right? And consumers now have lower interest rates. Okay, so that should be a boost to consumption as well. Next, the US dollar, after being extremely strong for the last 2 years, the US dollar has also begun to weaken, which is good for corporate earning, right? So remember, generally, when the US dollar goes down, companies make more profits from remitting money from overseas. And the S&P earnings do better. Yeah, I repeat that. US dollar go down, corporate profits better, stock market go up. Okay? US dollar stronger, corporate profits go down, stock market not as strong. Now, it's not a perfect correlation, it's not perfect, but generally, a weaker US dollar means strong. Next, remember that 70% of US GDP comes from consumer spending. As long as the consumer keeps spending money, the economy will grow. Okay? Can the US consumer continue spending money? Well, one good sign is that US household net worth and cash are at record highs. In a while, I'll show you all the data. I'll show you all the charts in a while. I'm just giving you a summary, all right? And real income growth, which are wage growth over inflation, has been increasing. So this should support, continue to support consumer spending in the US. Number 7, and this is my favorite reason is that generative AI, artificial intelligence, and automation is at the early stages, and it is massively increasing company productivity. With AI, companies are being more productive. They need less people to do the same work, and the people are spending less time to do the same work. So this reduces cost and increases profits and will drive earnings growth as well. Finally, there's $6 trillion sitting in cash by retail investors and institutionals that have not been put into the stock market yet. Once the 6 trillion, well, not all of it, but even if 1 trillion goes back into the stock market, which it came out of in 2023, that would drive further returns in equity. All right, so let me show you the charts right now. Okay, so again, first reason, the Fed has now pivoted from killing inflation to supporting the economy. Okay, now what's interesting is, when was the last time this happened? When was the last time we had super high inflation and the Fed raised interest rates to kill inflation until they stopped? The last time was in 1982. 1982. Paul Volcker was the Fed chairman at the time. And in October 1982, he pivoted and stopped raising interest rates because inflation was defeated, right? Now, when that happened in 1982, the stock market went up 30% over the next 12 months. Where are we now? Well, our Fed chairman, Jerome Powell, declared victory in December 2023, which is about 1 year ago, right? And since then, the market is up, since December 2023, is up, if I'm not wrong, it's up about 20% so far, right? Since this point. Maybe less. Right? So that's why I say we have another 10% more to go for this year. Right? Again, this is just a theory. Yeah? Second, S&P earnings are beginning to grow again. So again, check this out, everyone. Now, a lot of people wonder, how come there was no recession in 2023? Everyone predicted a recession. How come it didn't happen? Well, the answer is actually, we did have a recession in 2023. We did have a recession. But it was not an economy-wide recession that hit every sector. It was a rolling recession. What is a rolling recession? A rolling recession means a recession that hits certain sectors only. Example, in 2023, the finance sector was in a recession. The healthcare sector was in a recession. The industrial sector was in a recession. But the technology sector was not in a recession, right? So it pulled up the other sectors. You get the point? Now, if you look at the S&P 500 earnings growth, what do you notice? The earnings growth was negative last year for 3 quarters. So this is called an earnings recession, which I mentioned earlier on, right? So the good news is that the earnings recession has already bottomed, and as of quarter 3 2023, earnings have now started to grow again. So we're now in a new earnings growth cycle. You get the point? Okay. Now, again, this is quarter 3 2023. So what do we expect in quarter 4 2023, which is now being reported, plus the rest of the year? Well, you can see it over here on this chart here. Let me blow it up for you. Okay. So can you see this is quarter 4 2023? We are expected to grow at 11%. All right? Okay, sorry, let's take this one. This is the more optimistic. Let's take the more pessimistic one. We're expected to grow in quarter 4, 2023 at 2.9%. 2.9%, right? And for the whole of 2024, we're expecting earnings to grow at 11%. And for the whole of 2025, we expect earnings to grow at 12.5%. So in other words, like I mentioned, we are in a new earnings growth cycle. So that should support the bull market, right? Number 3, as I mentioned, the Purchasing Managers Index or PMI index is bottoming, okay? So in red is the manufacturing index, in blue is the services index. So you can see that in the last 12 months, you can see it's been falling. You see the blue line falling and the red line falling. But the red line, if you take away the dot-com crash and the great financial crisis and the COVID, which were outliers, right? If you take the normal range, you can see it hit the bottom of the range. And as of 3 days ago, this is now growing again. All right, so it's not picking up here. It's not picking up. So we have bottom, and manufacturing and services activity are growing again from, and this again is constructive for industrial companies, especially industrial companies. Yep, this just came out, right? US PMI composite at 52. Anything above 50 means expansion. Services business activity 52. US manufacturing output, this is the only one that's still at 48, right? But US manufacturing PMI at 50. So this just came out as of 2 days ago. Next, falling treasury yield, which I mentioned. So again, the long-term interest rate was at 5% and it's dropped all the way now to about 4%. So we have a bit of a slight rebound here because recently we had better than expected retail sales and better than expected job numbers. So that caused a bit of an uptick in the 10-year yield, but it's still way below. Now, of course, if this bounces back up, then it's not going to be good for small companies that have a lot of debt. It will not be good for companies that use a lot of debt, like REITs, okay? But if it can continue to be within this range here, which I think it would, then I think REITs can continue to do well and small cap companies can continue to rebound, right? The good news is that if, like me, the majority of the stocks you're holding are the high quality companies like Amazon and Meta and Microsoft and Nvidia, all these magnificent companies that are not affected by interest rates. They're immune to higher interest rates because they have a lot of cash, right? Even if this bounces back up, which I don't think it would, I wouldn't worry because my companies will still continue to do well. This, if it bounces back up, will only affect the less profitable companies or the companies with higher debt levels and REITs, right? Okay. Next, let's look at the US dollar. So again, US dollar went up like crazy in 2022, and since then it is now in this range here. So as long as the US dollar remains in this range, again, it will be good for corporate profits. Okay. Next, how is the US consumer doing? Some people say, oh, the US consumer has run out of money, they have run out of savings, they can't spend anymore, they're in debt, blah, blah, blah. Look at the freaking numbers. First of all, the US consumer, their income is still increasing above inflation. We call it real average hourly earnings. And you can see that, oops,